to On the Money right here on WDBO, AM 580, always streaming inside your WDBO app. Also on the 96.5 HD2 channel on the FM dial. If you got a HD radio in your car, go ahead and hit the HD2 on the 96.5 FM dial, coming in crystal clear on that big old signal. If you want to join the conversation, the number is 844-580-9326. We'll get to that in just 1 second, because this is On the Money. This is your chance to pick the brains of two certified financial planners with the Certified Financial Group office here in Longwood. For the better part of 3 decades, for over 3 decades, these trusted voices of the Certified Financial Group have been on the airwaves answering your questions, you, the listeners of WDBO. They've been doing so, and they have had great success guiding our listeners to and through retirement. Today we got Dillon Little and Joe Bert. Gentlemen, how are we doing this day?
Good morning, Josh. We're doing great. How are you doing?
I'm doing fine as always.
Well, as you said, we introduced one of the new members of our family this morning, Mr. Dillon Little, sitting here right at my side. Dillon, welcome.
That's right, Joe. Thank you. Happy to be here with our listeners this morning, and eager to see what might be on their mind regarding their personal finances.
Well, you know, there's a youth movement going on here at CFG. In fact, it's one of the challenges that our industry has is that it's been started by a bunch of old war horses like me over the years, and as we old war horses begin to retire and perhaps fade out of the business, I have no intention of doing that immediately. But we recognize that, you know, the longevity of a firm is really a function of the quality of the people you have. And we're delighted to have Dillon Little as a part of our firm and one of our newly minted certified financial planners. So, Dillon, why don't you tell our audience a little bit something about yourself?
Well, as Joe mentioned, I'm one of the newer planners here at Certified Financial Group. I've been in the business about 3 years now. Went to the financial planning program at University of South Florida over in Tampa. Sat for my CFP exam. Post-graduation, interned for a summer here at Certified Financial Group, and been here ever since. And as Joe mentioned, recently minted as a certified financial planner in June of last year. And just kept rolling from there.
Yeah, and Dillon does a great job. You know, when he came in as an intern, we already saw a diamond in the rough here, and we were delighted that he decided to join our firm. And as he said, he sat for a CFP exam. Why don't you tell our listeners about that? You know, because we have 16 certified financial planners here now, and we talk about what it is. But why don't you tell our listeners really what's involved in going through that exam and what you have to do?
Well, I'll be honest, it is no walk in the park. I took about 2 months and studied for hours and hours on end to ensure that I'd never had to do this again, and it really goes into depth of, all of the things that we deal with day to day with our clients, things like tax planning, investment planning, retirement planning, estate planning, most recently, the psychology of financial planning, because a lot of what we do on a day-to-day basis is behavioral management as well as money management, and just very in-depth with each one of those topics. And total exam time is about 6 to 8 hours, I believe.
6 to 8 hours and then you push the button and
if you passed or failed immediately. So when I hit that button, it was about the longest second of my life, but luckily I passed.
Well, congratulations to you.
Thank you, Joe.
I know it's a lot different than when I went through the exam many years ago, and it is a comprehensive exam. As we say in some of our ads, anybody today can call themselves a financial planner or a wealth manager, investment advisor. There's all those terms. Now the big term today is fiduciary. But the Certified Financial Planner is a designation that we're very, very proud of, and very proud to have 16 of them right here. And with that being said, I see we have a call there, Josh, so let's take it away.
You got it. If you want to also be one of the callers, talk to Dillon Little and Joe Bert with the Certified Financial Group. Pick up the phone right now. Dial 844-580-9326, 844-580-WDBO, or send in your question using the open mic feature inside the WDBO app. Bob is calling all the way over from the East Coast in Melbourne. Go ahead, Bob. You're on the air.
Good morning, Bob.
Hi.
What's up?
Morning, Bob.
Hi, thank you, guys. From time to time, I will receive a notice from a financial place that if I don't do something with my account, it will be abandoned to the state. And it's no big problem. I just call them and tell them I'm here. And as I understand it, abandoned property, I would have a certain amount. These accounts are over half of the value is unrealized capital gains. If I did let it abandon and then reclaim it, would there be a step up in cost basis?
Well, I really like your creative thinking, Bob. So let's go back to what you're proposing. You own the accounts, right? They're in your name now.
Yes, and they're just personal, not any retirement.
I understand. So they're in your name now, and your thinking is you're going to let them, what they call, is cheat to the state, which means they go into unclaimed property, right? And then you hope to someday go back to the state and claim it and avoid capital gains and get a step up in basis.
Exactly.
Well, I like your creative thinking, but Dillon, what do you think?
Yeah, I think that if that were the case, I think a lot of people would be abandoning their accounts.
Yeah, unfortunately, you can't do that.
Okay,
yeah,
I
but-
just
No, but it's, I really like your creative thinking. I've never heard anybody suggest that, and that probably takes the cake, at least for 2025, of the creative idea for the year. So, yep, sorry to have bad news for you in that regard. But in fact, I'm not sure how your property would be as cheated if you're still living.
Well, the funny thing is they do mail me statements, 1099s, and I continually reinvest dividends and capital gains, but that's kind of on autopilot, I
Right,
guess.
right.
And it doesn't count as if I personally initiated a transaction.
Right, but it's once they start getting return mail from you that nobody's there, have moved and no forwarding address, or they track you down and find out you passed away, that's when it would go to the state. So you just can't walk away from it and send it to the state. And then I like your idea.
Well, now, according to the mailing,
Yeah.
it would. I had like a month or two to initiate a contact, or according to what they mailed me, it would go to abandoned property.
Ah, okay.
Even whether they tried to get a death certificate or what, they just said it was going, and all I had to do was call them on the phone and
Yes.
say hi. you
Yes, yes. Huh.
know. But I was thinking, well, what if I do let it
Yeah.
go and then reclaim
Got
it?
it,
But like
got
I
it.
said,
Yeah.
I guess that's not on your guys' exams for your.
No, I guess it's not. So we just learned something. But we do know, I can guarantee you that you would not get a step up in basis. Don't you agree, Dillon?
I agree, Joe.
Yeah.
Oh, I kind of figured that. But what the heck,
No, why not try? I hear you. But you appreciate the call, Bob, and have a great weekend.
All right.
Okay.
Thank you.
All right. And our topic for the day is, what is it, Josh? Dillon, pull it up.
No problem. If you want to, again, join the conversation, 844-580-9326. Send in your open mic using the free WDBO app. The topic of today's show are inherited IRAs. What has changed in 2025?
A lot, right, Dillon?
That's right, Joe.
So let's tell our listeners what's going on.
And this is something that has come up a lot in recent client meetings, and a topic that, quite frankly, has experienced a lot of changes in recent years, has led to somewhat of a confusion, both for, professionals such as Joe and myself, and as well as our clients. So before Secure Act, which went into effect in 2019, late 2019, if you inherited an IRA from somebody, you were able to stretch those annual distributions over your lifetime.
That was Secure Act 1.0.
Secure Act 1.0, that's right. Now, post Secure Act 1.0, so starting in 2020, the IRS says, we need to accelerate, depleting these accounts. So if you inherited an IRA 2020 or later, you had 10 years following the death of the original owner to distribute that account. And, the impression of many in our business and of our clients was, you're not subject to annual distributions. It just had to be withdrawn by year 10. And the IRS, they kept on giving out notices saying they're finalizing regulations, and it was kind of up in the air. So they would waive any penalties for not taking distributions. So starting in 2025, this year, if you inherited an IRA post Secure Act 1.0 and the original owner had already been, that means that the annual distributions cannot be turned off. In fact, they have to remain on. So you have to take an annual required minimum distribution from your inherited IRA, and the account has to be withdrawn within 10 years following the death of the original account owner.
Unless you're a spouse.
So this is for non-eligible designated beneficiaries.
Right.
So an eligible designated beneficiary would be a spouse, somebody not 10 years younger than you,
Disabled person.
disabled person, chronically ill individual, but
Minor child.
most people will fall in the non-eligible designated beneficiary category.
Right. So this is generally the children, grandchildren, neighbors, friends, lovers, whoever it might be.
That's right.
So generally it's the non-spouse. That's that. So the rule is now you have to you have to drain the account within 10 years.
Yes, in addition to taking an annual distribution.
Got it. All right. There you go. That's Rule number one. One other kind of, and by the way, I hear the bumper music. Before we take off there, a week from today, we're going to be talking about that in detail. Dave Bella-Christian is doing a workshop on that, Secure Act 2.0. If you want make a reservation for that, go to our website, financialgroup.com. That's financialgroup.com. Next Saturday morning, 10 o'clock, right here at our offices in Altamont Springs, right here in our learning center. That's financialgroup.com.
Thank you so much. If you want to join in, call in right now, 844-580-9326, 844-580-WDBO. Joe Bert and Dillon Little with the Certified Financial Group here answering your calls. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
Of your moms or dads or friends calls the broker and says, you know, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have, that's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, or we're planning tomorrow, today. For more than 40 years, our certified financial planner professionals acting as fiduciaries have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're Certified Financial Group, where we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices, the documented, repeatable processes, and the
Here on WDBO AM 580, always streaming inside your WDBO app. This is your chance to hop on the air, hop inside of the experience, the length of education, all the upkeep it requires to be a certified financial planner here in Central Florida, because we got Joe Bert and Dillon Little with the Certified Financial Group answering your questions. If you want to call in, 844-580-9326 is the number to get a hold of them. 844-580 WDBO. Joe, Dillon, we got a question that rolled in through that break. You want to get to it?
Let's do it.
Absolutely.
All right. We got Jim from Longwood. He's got a bit of a long question here. We got about 5 minutes left, so I'll get through it. My neighbor recently told me that he converted his IRA worth about $100,000 to Roth. I'm 65, single, and not yet collecting Social Security. I have an IRA worth $800,000. Are Roth conversions something that I should consider?
Consider, but you got to be careful, right, Dillon?
Yeah, I'd say the answer to this question, Joe, as many others in our business, is it depends. Something I would ask this person is, are you still working? Are you retired? I know they mentioned they're not collecting Social Security. What are their sources of income? If they are retired, not applicable to everybody, but in the early years of retirement, before you start taking Social Security and before you're required to take distributions from your retirement accounts, a lot of people have, lower income than they did when they're top end working years. So in that span of time, depending on your situation and your income sources, Roth conversions may make sense in order to fill up those lower tax brackets at a lower tax cost, before your forced income is higher later on in retirement. Trump's in office now. The Trump tax cuts are through this year. It's kind of up in the air as far as how long those may be extended past this year. So if tax rates are going to be higher in the future, potentially, or stay the same, it may make sense to bird in the hand is better than two in the bush and kind of fill up those lower brackets now while taxes are lower. In addition to that, I would say, Roth conversion may make more sense in a market downturn. You can convert more shares to Roth in an account that will grow tax-free when values are down.
Well, while you're on that, I know exactly what you said, but when the market is down, you have the same number of shares, but they're worth less.
That's right.
So what the important thing is the dollar amount, and you can transfer a lot more shares because the shares are worth less, and then you transfer in the Roth and hopefully get the appreciation back there. So that's a time perhaps to consider doing a conversion as well.
That's right, Joe. And something that we do for our clients is, if they're in a diversified portfolio among several different asset classes, we can set alerts for particular asset classes saying, if small cap's down 20% or international's down 20% or large cap growth is down 20%. That may be a trigger for us to try to look at, Roth conversions more closely and convert a particular asset class. So again, so we could convert more shares at a lower tax cost to an account that will grow tax-free.
Right. And what you don't want to do is rush up, and I've seen this, and I know you will in your years to come, Dillon, is that some people get, see the benefit of the Roth, the tax-free income. They cash in a huge IRA, pay a huge amount of taxes on that, and then what happens if they're collecting Social Security and on Medicare, they've just blown up their IRMA account,
right.
their IRMA tax on their Medicare premium. So you've got to be very, very careful on the Roth conversions. And once again, Dave Bella Christian will be covering this in detail next Saturday morning right here at offices in Altamont Springs. But yeah, Roths are okay. I like the Roths if you're in a lower tax bracket. But when you get up in that 22% tax bracket, it really doesn't make sense to me. And the important thing is, too, if you do the math, in order to get the benefit, the full benefit of what you're trying to do, you have to have dollar for dollar go into that Roth. So if you move $100,000 and you pay $22,000 in taxes, and you only put $78,000 in the Roth, you've really set yourself back. So what you want to do is to reach into your other pocket, other account, and pay that $22,000 to have the full $100,000 going in the Roth. If you do the math, if you do the math, and you will find that if you don't do that full conversion in that Roth account, you're never going to get to where you want to be, or you'll never be as good as if you had left the money in the account, in your taxable account to begin with. So, yeah, those are all things to be careful of in doing those Roth conversions, and we've seen it that unfortunately people come in the office the year after they've got that big tax bill and said, "Oh my gosh, what did I do? I should have seen you guys last year. And I heard you talk about it on the radio, but I thought I could do it on my own." And my brother-in-law or my stockbroker said this was a good idea, and I ended up buying an annuity. It wasn't such a good idea. So be very, very careful about that on Roth conversions. They do make sense in some cases, and in some cases they can be a ticking time bomb if you don't know what to look for. So these are the things that Dillon and I and the 15 other certified financial planners at Certified Financial Group work with year in and year out, day in and day out, helping our clients get to and through their retirement years. If you want more information about what we do and how we do it, go to our website. That's financialgroup.com. That's financialgroup.com. And I hear the bumper music. So, Josh, take it away.
That's right. Plenty of ways to get in touch with the Certified Financial Group. It looks like we got Dave Balakrishnan taking calls off the air. If you want to call in live on the air, there's a number 844-580-9326, 844-580-WDBO. That'll put you in touch with Dillon and Joe to answer your question live on the air. If you got a question of a more personal nature or you want to get right to the brass taxes, Dave Balakrishnan is answering calls inside the office of Certified Financial Group, and that number is 407-869-9800, 407-869-9800. You're listening to On the Money. We're planning tomorrow
Today
with the Certified Financial Group.
Certified Financial Group, where we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey, and these guys know more about
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. If you want to hop on the air, hop inside the experience, inside the offices of Certified Financial Group. We have Dillon Little and Joe Bert on the air answering your questions. The number to call in is 844-580-9326, 844-580-WDBO, or send in your open mic using that free WDBO app. We also have Dave Balakrishnan standing by in the office, taking your questions off the air. If your question is a little more of the sensitive nature, or you want to get right inside the four walls of the office at Certified Financial Group, you can go ahead and call Dave now at 407-869-9800, 407-869-9800. Back to Dillon and Joe, and back to our topic of today's show, inherited IRAs.
Yeah, we covered a little bit before the break, talking about somebody inherits an IRA of 65 years. No, that was a Roth. That was a Roth we were talking about. You want to go back to the Roth?
Sure.
Yeah.
So, if you have inherited a Roth IRA post-Secure Act, the regulations are now finalized to where you do not have to take an annual distribution from this account. It just has to be withdrawn within 10 years. I mean, in the eyes of Uncle Sam, this money has already been taxed. So, the IRS really has no benefit to require you to take out an annual amount. So, say you inherited a Roth IRA this year, you could allow that to grow until 2035 and then withdraw that full balance in 2035.
But it has to be withdrawn. Of course, when you take it out, it's not taxable.
That's right, it's tax-free.
Right. So it's not like you have a tax time bomb waiting for you. You just, and then, of course, the smart thing to do if you don't need the money, just let it continue to compound and grow for 10 years and then make that withdrawal.
That's right.
Yeah. So those are things to consider when you make conversions. Anything else you want to cover on that topic?
Absolutely. So one thing that's important to note about these inherited IRAs that are now subject to annual RMDs starting this year is that this 10-year window is not retroactive. So if the IRS waived the penalty for not taking a distribution in years 2020 to 2024, let's say that you inherited an IRA in 2020, your 10-year window still ends in 2030. So if you haven't taken any distributions, to date, then now you have 6 years instead of 10 years to kind of take the balance of the account out. So, you have a minimum amount you have to take out starting this year, but it may make sense to take more than that depending on your income, especially if it's years where you have lower income. So you're not with a potentially large tax bill in year 10.
Yeah. So those are all the complications that you have when it comes to having to make that out. And the only thing I can say, Dillon, is that when I started in this business, we did not have the software that we have today to be able to do these calculations. Everything was done with a calculator and a spreadsheet. And then we had Lotus 123 for some of our. Do you know what Lotus 123 is?
Couldn't tell you.
That's the predecessor. That's a predecessor to Excel.
Okay.
And it was when that came out. This was the greatest whiz bang thing. And then of course, now today we have Excel, and then we have the software that's built exactly to determine that and the impact of taking that IRA or that distribution, and what impact it has on your Social Security taxation, what impact it has on your Medicare taxation. And those are all the things, the wonderful tools that you have as the young generation coming in here that this old man didn't have when we were in the business. And frankly, I'm still learning, trying to keep up with these folks, but they do a great job. And we're delighted once again to have Dillon as part of our team. Anything else you want to cover on that topic?
That's right. So unfortunately, what we're noticing with, now people are required to take required minimum distributions from these accounts starting this year is that a lot of these IRA custodians are not posting the amount on the statements of how much they're required to take out. So if you're in a situation to where now you have to take an annual distribution, you may be wondering, how much am I supposed to take? So you need two things. You'll need the December 31st prior year balance of the account. And then for most non-eligible designated beneficiaries, you will use the IRS single life table. So you can go to the IRS website, look up single life table, and there'll be a factor based off of your age that'll be at the end of how old you'll be at the end of this year. And so you'll divide the December 31st prior year account balance divided by your end of year age factor, and that's the minimum amount that you're supposed to take out this year.
There you go. And if that sounds complicated, it is.
It is.
It is.
Right.
I have no idea why the government makes these things so complicated. It's probably since the Certified Financial Planner Full Employment Act is what it is. So that's why we're here. Yeah. So I see we have another text question flowing there. Josh, so take it away.
You got it. Thanks, Joe. If you want to call in, 844-580-9326. Marianne wants to know, the HR director at my company said that I can contribute more to my 401k as a catch-up contribution than I could last year. I'm 61 years old. Is this true?
Yes, it is. So this is something that's new with Secure 2.0, which came out a couple years ago. So this is a new amendment, I guess, that came in and starting in 2025, and that says that for those ages 60 to 63, you have what's called a super catch-up. So in addition to your normal 401k contribution, you can contribute an additional amount that's above the standard age 50 plus catch-up, which is $7,500 for 2025. Now, if your age is 60 to 63, you can contribute an additional $11,250 for this year. But
Not on top of the 7,500.
Not on top of the 7,500.
Right. So
in lieu of.
In lieu
of.
Yes.
And what's important about this rule is that, again, this is going to be based on how old you will be as of December 31st. So if you're age 59 and you're turning 60 this year, this applies to you. But if you're 63 and you're turning 64 this year, you can no longer do this, and your catch-up contribution will revert back to the standard age 50 plus catch-up.
So the quick takeaway is, if you're going to be 60 this year, you don't have to be 60 right now, but if by December 31st you're going to be 60, don't walk down to the HR department and increase that contribution that the government's allowing you to do for this short period of time up to an additional $11,250. Right?
That's right.
Yeah.
Yep. Just another way that government's trying to promote additional savings.
Yes, and that's called a super catch-up.
Super catch-up.
Not to be confused with the super mustard.
No.
Okay. We're off the deep end here this morning. All right, I see we have another text question there. Josh, take it away.
Thank you much. Don said, somebody at my church mentioned that their donations to the church go towards satisfying their required minimum distribution. I'm turning 73. Do I qualify?
So I'd say if you have a traditional IRA, then the answer is yes. So this can be done via qualified charitable distribution, or QCD. So if you make a QCD, it has to be directly from your IRA to the 501c3 charity of your choice. And this will not be included in your taxable income, and it'll fulfill your required minimum distribution for the year. So a couple important things to know about QCDs is that, one, it has to come directly from the IRA to the charity. So you can't, take a distribution from your IRA, put it in your checking account, and then give it to your church. No, you have to give it directly from the IRA to the church in order for it to count as a qualified charitable distribution and count towards your.
However, they can send you the check payable to the charity.
That's right.
Yes.
That's right.
Yes. So it doesn't have to go directly to them, but it's got to go to them through you. But the check has to be payable to the church or the charity, and not to you to then write a check to the church or charity.
Exactly.
And I think that's where some people make mistakes. So what are the benefits of doing a QCD once again, Dillon?
Well, again, I mean, for those that are charitably inclined, it is satisfying their required minimum distribution for the year without it being counted in their taxable income. So kind of an additional tax benefit, like I said, for those that are charitably inclined. But another thing that's important to know about QCDs is that if you're writing a check from your IRA to a charity, that has to be cashed by December 31st of that year in order to count towards your required minimum distribution and a QCD for that year. So if you're, December 1st rolls around, you're writing a number of checks, you're trying to fill up the last bit of your required minimum distribution, I would say you might want to contact those charities and say, hey, please, can you make sure you cash this in by the end of the year? Because unfortunately, every once in a while, people are aware of this and you'll say, hey, well, they didn't cash it till January 2nd, and it's fortunately too late at that point.
Yeah, and then, it just gets back to what I just said, excuse me, a minute ago, where you're having a check sent to you and you want to hand it to your pastor on Christmas Eve, and he or she takes it, and then then not cashed until January the 2nd, you've just blown the QCD. So you got to be careful about the ins and outs of the QCD. It's a great idea because it can impact the taxation of your Social Security, perhaps impact your Medicare taxes, depending on what you do. So you want to, be careful on doing the QCDs. And what I want to encourage our listeners, we know we have a lot of people that are taking advantage of this. Please do not wait until December to do this. We'd like to get this started before the start of the fourth quarter, right, Dillon?
As soon as possible.
Yeah.
And also, one more thing is I would say if you are making QCDs, it's important to let your tax preparer know that you're doing this, because at the end of the year, you're going to receive a 1099-R from your IRA custodian, and it's just going to show, total distributions from your IRA. It's not going to delineate what was a distribution to you and what was a QCD. So if you are making QCDs, one, let your tax preparer know and try to, line item which was a QCD and which was not, so that they can report what's included in your taxable income correctly.
Yeah, that's a great point, because the 1099-R just doesn't designate it as a QCD. And you don't get the benefit of the QCD.
That's
if
right.
you're a tax preparer, you don't know. So, so be careful on that. And another text question there, Josh?
Of course, that's our final one so far. So if you got one rolling in, call in 844-580-9326, 844-580-WDBO, or send in your question using the free open mic feature inside the WDBO app. Harry from Mount Dora says, are CDs still a good option? My current one-year CD, which is paying 4.5%, is maturing in April, and I'm not sure if I should even renew it.
Well, it depends.
That's what I was going to say, Joe.
They teach you that in CFP school?
They do. They do. Yes. So the first question I would ask this person is, if you're in a CD now, is this short-term money? Meaning, is this something that you're going to spend on a purchase in the next few years? Is this just extra savings, or is this long-term money? If it's short-term money and, you're coming up on the renewal, you could probably get a one-year CD in the, 4 to 4.25 ballpark right now. U.S. Treasuries are still paying about that on 1 year. Money market funds are paying about 4%, some of them currently as well. We had some hot inflation data come in this week. So, some of the talking heads may think that interest rates may not be lowered by the Federal Reserve as quickly in 2025 as we're thinking. Some still think that we might be. So money market rates and CD yields may hold up longer. They may not. Again, just kind of depends on where interest rates go and how the next couple months of inflation data come in. But on the flip side of that, if this is long-term money that you just kind of socked away in a CD, I would encourage you, if this is money for retirement or age 20 plus years from now,
or even 10. Even 10 years.
Even 10 years, right. Consider investing these funds in a diversified portfolio, adjusted to your risk tolerance to beat inflation and, for long-term growth.
And that's the whole key. We've seen what inflation has done in the last couple of years. And, even if you're getting the inflation rate today, which just number came out in 3% range, and if you're getting 4, you gotta have to pay taxes on that. So maybe you're netting a little bit over 3. You're just treading water. You're getting absolutely no growth on your dollars. And we do know in the years to come, the cost of gasoline, groceries, electricity is going to be more than it is today. So you have to get your dollars to grow. You want to look at where that money is. Is it money that, as you say, Dillon, you're going to be using in the short term, and that short-term money you don't want to invest. You want to have something liquid, something that you know is going to be there when you need it. But you got to think of what are these dollars for? Are they for the long term, for the rest of my life? If that's the case, you need to get those dollars to grow. And frankly, that's what we do for our clients, getting them to and through their retirement years, building a diversified portfolio, actively managing it, and being sure you always have quality investments in your portfolio. Once again, we got a workshop coming up, right, Dillon, a week from today at our offices right here in Altamont Springs in our Learning Center. Dave Bella Christian, who is taking calls off the air, will be hosting that. It's Secure Point Act, some of the things we talked about earlier in the program, about things you need to consider, things you need to know, who get the benefit of Secure Act 2.0 and some of the pitfalls. If you want more information about that, go to our website. That's financialgroup.com, financialgroup.com. You can click on the events tab there, and you make your reservation right there online. It fills out fast, so we encourage you to do that, and we hope to see you here next Saturday.
And we hope to see you here on the air if you want to call in, 844-580-9326, 844-580-WDBO. Send in your open mic during the break, and I'll play it live on the air as if you're sitting here in studio next to us. You're listening to On the Money, where we're planning today with the Certified Financial Group.
Of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, And I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, you know, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
On WDBO AM 580, always streaming inside your WDBO app. As this episode comes to an end, this Saturday at 9 o'clock episode comes to an end, I want you to write down this number to talk to Dave Balakrishnan in the office of Certified Financial Group. That's 407-869-9800. That's a good line for you if your question is a little bit sensitive, or if you want to, maybe the question comes into your head as the show comes to a close and there's no more time left of this episode. But write it down. Dave Balakrishnan with Certified Financial Group, 407-869-9800. Today we got Joe Bert and Dillon Little's pioneer episode of the On the Money show with the Certified Financial Group. But let's go to Pamela, who's calling in from Orlando. Go ahead, Pamela. You're on the air.
Good morning, Pamela. What's up? Pamela. Good morning, Pamela. Well, did we lose Pamela, Josh?
Let me try and see if I can get a hold of her real fast.
All right. Do your magic there. 1, 2, 3.
Nope, it appears we're having some technical difficulties with Pamela. So we may want to talk about some workshops or Score My Funds, and I'll try to get a hold of her.
Yeah, we've had a flurry of folks checking in Score My Funds. It's an opportunity for our listeners to have the quality of their mutual funds determined. We use a system that's provided by the Center for Fiduciary Studies. It's totally objective to rate the quality of your funds. How does somebody do that, Dillon?
So you go to scoremyfunds.com and you can look up the ETF or mutual fund of your choice. No individual stocks, just ETFs and mutual funds. And if you don't know the ticker symbol, there's a drop-down menu where you can search, the name of the fund, and we'll have a detailed report to you within 48 hours that, compares the quality of that fund based off of 11 distinct criteria, such as, rolling returns, manager tenure, how much risk the manager is taking for the return that they're getting, compared to all of its brothers and sisters in that particular asset class category.
So you're comparing apples to apples. It's a subjective, or I should say objective return, look at your fund or ETF and grade it against its peer group on 11 distinct criteria, and we will send you that score within 48 hours. Absolutely no cost or obligation. If you'd like to follow up, we'd be glad to do that for you as well. It's our clients it's something we do with our clients always, and it's
on a daily basis.
On a daily basis, we're looking at the quality investments that they have, and When we build portfolios, we're only checking or choosing from the best of the best to build those portfolios. And things change with mutual funds over time, don't they, Dillon?
They do.
What goes on?
Manager tenure. I mean, if it's if it's not an index, if it's a more actively managed fund, and it's not a management team, if the manager leaves, they retire after a long career managing this fund, it's basically a new fund. So we may look at that fund and say, well, is this a disciplined process, or is this guy kind of a gunslinger manager? And if that's the case, then we may look to, get out of that fund and move to something similar.
Right. Well, over time, they have what's called style drift.
That's right.
Which means
that, the criteria is 20% has to be in that particular, no more than 20% cannot be in that particular asset class. So a large blend has to be 80% large blend of growth and value. And if it drifts more than 20% from that category, it gets a red X for style drift. And, with the market being so growth heavy nowadays, we're actually seeing quite a bit of style drift.
And that's really important when you're building a diversified portfolio, because if you're getting a lot of style drift in a portfolio you built, what you built in January could look totally different by December, and what you thought the path you were going down without knowing it, because managers are making, and you have style drift involved, you end up where you thought you were buying a chocolate cake and you end up with a cherry pie.
Right, and what you've noticed is a lot of managers, say even in a value category, will have stocks such as Microsoft, Apple embedded in their value fund, which is normally can be considered a growth name, just to kind of boost that return a little bit, because those have been carrying the market here the last year or two.
And so what you want to do is what we call an X-ray, right?
That's right.
And what's the X-ray?
That kind of looks through the mutual fund, like Joe said, an X-ray, and just kind of see, what are the underlying holdings? How top heavy is that fund? The top 10 holdings, how much of that does it make up of the entire fund? And, what sectors and,
yep, you got
is that going for?
Yep, you got it. So once again, Dillon, welcome to the show. You did a great job of your initial intro into the radio world. We appreciate you being here. And once again, we're having a workshop a week from today, financialgroup.com. Josh, thanks for the great job you do, as always.
I appreciate it. Thank you for, I was going to try to haze Dillon today, but Joe wouldn't let me. So that happens today. Thank you so much. Again, Dave standing by, 407-869-9800, live in the offices of Certified Financial Group. You've just listened to On the Money, where we help you plan tomorrow today with the Certified Financial Group.